Hey, good morning, everyone. Welcome to our monthly Roundup webinar for the month of August. My name is Chris Lopez, and I'll be your host for today. I'm also a realtor with Your Castle Real Estate. So some quick background on these webinars. They're probably a little bit different than what you've done before with webinars. Our goal with these are to really think of them as like a let's get together for a virtual cup of coffee and talk real estate. So attending this webinar is live is the best. We can ask questions, we can interact, and that's really our goal, is to have a dialogue back and forth. So please ask questions, please share ideas, just whatever, please share it. But at the same time, we also know it's really hard to always attend live ones. So we also will post the recording to our website and our podcast channel. So if you can't make the live ones, please check out the recording on our podcast channel and listen to it on your cell phone, whenever it suits your schedule. So my co-host today is Charles Roberts. He is the president of Your Castle Real Estate. He's also a realtor and also a very successful investor. So Charles, welcome to the webinar.
Thanks, Chris.
And we've actually got a couple of special guests in here today as well. Our first guest is Joe Massey. He's the senior loan officer over at Castle & Cook Mortgage. He is a great loan officer and also an investor himself. So Joe, welcome to the webinar.
Hey, Chris, thanks so much for having me. Really looking forward to chatting about this topic today.
And a last-minute drop-in we have is actually Mark Cunningham. He is the president over at Grace Property Management. He's also an investor himself. He's actually doing some recordings with Charles today for some future podcasts and recording a property management course for the website. So really great content, and we'll have it out in the next few weeks. And since he was around, we wanted to bring him in as well. So Mark, welcome to the webinar.
Thank you very much. Appreciate being here.
All right, so let's jump into the first topic. I think as a lot of you know, I actually finished a fix and flip last month, sold it, and I always like to do a post analysis. Okay, what went well, what went wrong, what if I did something else? And so I started doing these numbers on, okay, what if I actually kept it and refinanced my hard money loan into a long-term finance and kept it as a rental? So I started, I'd emailed Joe back and forth a couple questions, and he was very helpful and helped me get the details right. But I still had more questions, and I realized, you know what? I'm probably not the only person out there with questions. And I very much like to do real-world case studies versus just, what-if scenarios that never happened or something that people did 10 years ago. This is real time. We sold the property, I think it was like July 15th or so only about 6 weeks ago. So here's a quick rundown just so you guys know the numbers. The fix and flip numbers, I bought it for $185. We bought it as a 3-bedroom, 1-bath, and we actually added a second bath, so we turned it into a 3-2. And this was in the north part of Denver, right around the I-25 and 36 interchange. We spent about $30,000 to fix it up, and that was for high-end finishes for the flip. Sold for $265, and after everything was said and done, the unexpected curveballs, carrying costs, selling costs, we walked away with about a $26,000 profit. So what I actually want to do here is Joe sent me over a really great spreadsheet. And I don't know, Joe, if it's easier for me to walk the spreadsheet through or if you want to take control and actually walk people through how these numbers work. Why don't you spend a minute? Sorry, go ahead.
I'll let you drive, but basically the highlights of this are, you can only fill in the areas in yellow. It's locked so that you can't start changing some of the formulas and making errors. So it is locked that you can only change the yellow highlighted fields, which prevents you from messing up the formulas that are going to actually give you your answers. But you really just start right at the top and work your way down, filling in each of these independent fields, and then the next tab will give you the answers to, is this a good deal or not?
So as I start asking Joe some questions, and also Charles and Mark, feel free to jump in here, guys. Anyone listening, type in your questions as well. Pick these guys' brains. And actually, Charles, I was talking to Charles last night. He wanted to be stumped on today's webinar. It's a challenge he threw out to me and the listeners. So stump Charles, stump Joe, stump Mark. So Joe, okay, looking at this, hindsight's 2020. If I actually wanted to refinance this after I fixed it up, where would I even start talking to you, the long-term finance guy? Do I need to talk to you before I buy the property or after it's fixed? Like, I don't even know where I would start with that.
Yeah, you would definitely want to start with me prior to buying the property. So if your hard money lender is always going to ask you for your exit strategy, and if your exit strategy is I'm going to buy the property, fix it up, and sell it, great. They're not going to ask you anything about your permanent financing. But if your exit strategy is I'm going to buy the property, fix it up, and then rent it out, they're going to say, great, we want you to rent it out, we want you to keep it, but who's your permanent lender that's going to do this refinance? And then you're going to kind of have a deer in the headlights look and say, oh, I hadn't thought about that. And you're going to reach out to me, and then we're going to go through your basic pre-approval application. Where do you live? Where do you work? How much money do you make, et cetera? And then I'm going to send you a pre-approval letter for this hard money refinance loan. Then you're going to share that with your hard money lender so they see you're already pre-approved for your exit strategy. So that's a really important piece is if you want to do this, start early. I've had people that have come to me after they're halfway through the project that, you know what, we really like this property, we're going to keep it as a rental, and we can do that, but sometimes they don't qualify. And so if that's their exit strategy, but they can't actually qualify for a loan, that can be a problem. So you want to make sure if you think you're going to keep a property, give us a call early in the process so we can make sure that that will actually work for you.
So is it the same underwriting guidelines if I were just to buy a property straight up with a 20% download as far as like credit score, debt to income ratio, or is it different in these scenarios?
It is different. This is a program that not every lender has. And what makes it unique is that we don't require any seasoning for you to use the new appraised value. So in this example, you purchased the price for $185,000, and after it was completed, that value was worth $265,000. Many lenders will still only give you a loan based on that $185,000 price until you have owned the property for 6 months or a year or even longer, depending on the lender. For us, we'll give you a new rate and term, which means we're just paying off the existing loan. We'll give you a new rate and term refinance based off of that new appraised value with no seasoning. So you could do this a month later, 2 months, 3 months, however long it takes to do your rehab. And that's something that's unique on these guidelines.
Hey, Chris, this is Mark Cunningham. I'll just comment real quick to reiterate what you just said there, Joe. That's big. That's huge for the listeners because I do this stuff, and I haven't run into hardly anybody that will do what you just said. That's one of the problems I have is I go to lenders, and they will only use that old appraisal. They will not re-season the loan as you just explained it. So that's a big deal.
I'm glad you're here today.
Yeah, I bet you are.
So I'm curious, why is that? Is it risky, or is that just a rabbit hole for why most lenders don't do that?
It's kind of a rabbit hole to go down, but a lot of lenders, every lender can make their own rules and guidelines, and that's just a common one that most lenders have. It is something unique that is a guideline that we don't have that restriction.
Okay. Now, as we were emailing back and forth, Joe, as you were helping me kind of get my original blog article up to par, a couple of things I did not realize is for these refinances, you have to do 25% down, and it's a quarter point higher on the interest rate, right?
Correct. It's a little bit of a higher rate, and you do need at least 25% equity in the property when you're doing the refinance.
Are those two the biggest difference in terms of like terms for doing this versus just buying straight up normally?
Correct. If you're just doing a regular purchase, if you're putting 25% down, your rate's going to be about 0.25% lower. Also, if you're just doing a regular purchase and we're giving you the loan at that time, you could do 20 or even 15% down. Of course, those terms vary. You might have a little bit higher interest rate if you're putting less money down. But if you're doing a refinance on this program, you have to have 25% equity in the property.
And so another question here for you, as far as like the seasoning period goes, do I have to have a renter in place with a lease agreement paying me rent before I could refinance with you?
No, as long as you individually, Chris, have enough income to qualify for the payment on your house and the payment on this new house, no, you don't have to have a tenant in place. But if you don't have enough income and we need that $1,900 from the new lease in order for you to qualify, then yes, you would need to have a lease and the initial month's rent check or security deposit check to show that lease is now in force.
So really, once I just had the tenant sign the lease and collected the first deposit of the month's rent, even if they lived in the property one day or haven't even moved in yet, that would be enough to use that lease income to qualify?
Correct.
Oh, cool. Okay. All right, guys, if you got any questions on the webinar, post them in here. This is your time to pick some brains. So as far as the, I know you do a lot of work with Pine Financial, who's a hard money lender in Denver. I did not get my short-term loan through through Pine Financial. Is this special, I'll say, hard money with no seasoning period to long-term finance loan? Is that only something to do with with Pine Financial, or can you do with other hard money lenders? What's how do you make those two relationships work together?
Yeah, so we can do it with any hard money lender. The important point is that you don't receive any cash back at the time of the purchase closing. And so it's important when you're closing on the purchase, even though you're not doing the refinance with me for 30, 60, 90 days, let me view the settlement statement before you close so we can make sure that you're not going to trip yourself up by taking cash out at the purchase, which some hard money lenders will allow. So that's the number one point. Number two, we're also not going to give you any cash out when you are paying off the hard money loan. So you can't take any cash out when you're buying the property. You can't take any cash out when you're doing the new loan with me. Now, many hard money lenders will allow you, they'll fund your renovations. Those funds just need to be placed into an escrow account and not just put out directly to you. So as long as you're not taking any cash, there's no restrictions. In fact, I closed one of these loans this morning, and it was just a private individual who was the hard money lender. He had lent money to a couple who bought a property, took them about 5 months to fix it up, and we just did the hard money refinance and closed at 9 a.m. this morning, about 2 hours ago.
Sorry, say that again. So just to clarify, so no cash out, but I mean, so I had three disbursements from my hard money lender for the fix-up cost. So if those go straight into my checking account, would that be classified as a cash out, or do I have to put those into an escrow account?
So they should not be coming directly from the hard money lender to you. They should be going to the escrow account to pay the contractors, or if they're advanced to your business account and then you're using that to pay the contractors, that's fine. But it can't be something that you're advancing money off of that like a line of credit and then you're using that money to pay other credit cards. It needs to be money that's used to renovate and rehab the property.
So would I need to have a totally just dedicated checking account for that, or do I need to be incorporated in LLC? Or?
Yeah, I would recommend having a separate account so it's easy to track what money is coming from that hard money loan and where it's going to pay it.
Okay, so even if I just do like a personal checking account that's dedicated to this one project, that would keep things clean enough for you guys to realize I'm not moving funds around?
Yep, that would work.
Huh, okay. So, Mark, I'm really curious. I know you said, I don't know much about your investing history, but you said you've done quite a few of these. Jump in here and, I mean, why do you do them? What have you experienced? What are some hurdles that you've been through and overcome?
Well, so philosophically, my goal is always to take a long-term approach to anything I'm purchasing from the investment side. So 10 years ago, I was acquiring as many as I could acquire, and as long as I had positive cash flow, baby, give me another one. But what I didn't realize is that works great when the market's going up and rental rates are increasing and values are increasing, but if things slow down or head backwards, that can be a recipe for disaster. So coming out of the other side of that, I am a little more conservative now on these. So I'm not some crazy anti-loan guy. I go out and I get loans on the properties and put them in place, but then what I want to do is go back then and dump everything I can into it to get it paid off, because I know from a long-term perspective I'm going to achieve that financial independence through having little or no debt and having reoccurring income, and that is easiest to accomplish through investing in paid-for real estate.
Okay. So, Joe, I'm going to walk through the spreadsheet here, and you can take control if you need to, but all you guys, like, I don't know if these numbers are, please give me your insight. So I estimate I'd spend about $20,000 in rehab cost versus $30,000 to fix and flip for, for a retail owner occupied. it probably could be lower than 20,000, but I just was just totally guessing. You guys have any rules of thumb or experience for, you know, how much less work you would need for doing like a, you know, turning into rental property versus selling it as a owner occupied?
Yeah, we're all sort of looking at each other, trying not to laugh. I mean, it's like, you know, some about this much. You know, there could be rules of thumb, but I wouldn't take any of them seriously. It's decisions made on the ground.
But
Okay.
I would add, this is Mark Cunningham. I would add, take whatever you're budgeting and double it, because things happen.
And double the time to do it.
And
too.
double the time. In the last 2 deals we did, on one we found a cracked heat exchange in the furnace that we weren't planning on, so that was several $1,000s to replace that. In the one we did before that, we found the sewer line, the main sewer line out to the street, had a hole, had a crack in that as well. So we had to go jack up the.
So you didn't do an inspection pre?
No, we did not do pre-inspection, and that's part of the reason we get such good deals on them. Is we'll
totally
buy it
understand.
as is.
That's right.
So we are taking the risk on
Indeed.
in that, and that normally pays off. And even in these instances, it paid off because we factored in that number. We knew we'd find something that was going to cost us an extra 10 grand.
And I'm assuming that was from a wholesaler in town.
No,
We won't say. Oh, really? Okay.
it wasn't.
Okay.
This is just through an individual who we approached that way. But things are going to happen. You have to be prepared for the unexpected.
Yeah. So you know, the one thing you don't want to do is fix it up for a flip and then rent it. That would be the freshman error you want to avoid.
Okay. All right, so I'm going to run through these numbers here, and you guys can just shoot holes in here and give me your insight. So the loan I got was 10% down, so it was a 90%, you know, leverage I got. 2 points at 10% interest rate. And so, Joe, I think the mortgage interest, the long-term 30-year fixed for investment was 4.75, but we put down, assuming 25% for the long-term refinance, then add 1/4 points at 5%, right?
Yep.
Okay. And these acquisition costs are the acquisition costs on your end for the long-term financing.
No, that would be your cost to acquire the property, things like property insurance, inspection, appraisal, transfer taxes, title insurance, your extraneous closing costs to acquire that property.
Okay.
So over on the right-hand side where you see hard money loan in the gray, that's where it calculates for you what is the hard money loan amount, how much you're going to pay on the hard money loan, and what are the hard money closing costs. So $4,100 are the hard money costs plus the $2,000 acquisition costs. So to buy this property, it costs you roughly $6,100 in costs at closing.
Gotcha. And that's from the points and the acquisition cost.
Correct.
Okay. All right, so moving on here, this is obviously the rent I could expect from the property. Coming down here looks pretty similar to the other spreadsheet you have for the long-term buy and hold. So put the property taxes in here, property insurance, repairs and maintenance. I kept it 5% because I figure if I fully rehab the property, hey, I know most of the stuff is brand new, or I know what to expect out of it. And we have to put in new plumbing and a few other just things we have to put brand new in there. So hopefully get some mileage out of there. So I don't know, what tab should I jump to here? Should I go to the hard money purchase tab, Joe, or the summary page? All right. So why don't you kind of explain what's going on here for everyone?
Sure. So on the top left, we've got our initial purchase breakdown. We paid $185 for the property, roughly $20,000 in rehab, $2,000 in acquisition costs, and hard money costs, roughly $4,100. The hard money loan that we got was $185,500. So your initial cash investment was $25,600. So the hard money lender, in this case, did 90% loan to cost, limited to 70% of the ARV. So you had to bring a little bit of money. You had to bring $25,600 to this closing. After all of your renovations were completed, we refinanced and we paid off $185,500. You had mortgage closing costs. You did have your loan again, your closing costs again. And then we gave you a new loan of $190,000, which is less than 75% of that $265 value. So over to the right from there, you see the after repaired value was $265, the new mortgage balance of $190, and total equity of $74,956. So in this strategy, you put about $25,000 of your own cash in, but you've built an additional $50,000 of equity by keeping this property and not selling it. Below that, you see your total investment is $25,600 for your down payment. You had to make 4 hard money loan payments. They were a little over $1,500 a piece, so $6,100 while you were doing your rehab. Your total cash investment is at $31,783. Does that make sense?
That makes sense.
Okay. Now, here's our cash flow statement. The annual rental income is $1,900 a month. I factor in 5% vacancy. You can adjust that as you wish, but I like to use 5% to be conservative. So our expected annual rental income after vacancy is $21,660. We have our expenses. We've got to pay real estate taxes. We've got to pay property insurance. We're managing the property ourselves, so property management is 0. Repairs and maintenance, we've got to be reserving for those. And in this case, it looks like you're paying the utilities and estimating about $100 a month. So our total annual expenses, $4,240, gives us net operating income of $17,420. Now we do have to pay the mortgage, and the calculation is broken out to the right. $190,000 at 5% equals $1,020 per month, times 12 months is an annual mortgage expense of $12,242. That gives us annual cash flow of $5,178. So that's a cash-on-cash return of 16.3%. And if we look over on the right, it shows you the breakdown. That's $5,178 divided by the $31,000 investment. We're making 16% on the money that we put in year 1. Year 2, we're going to make 16%, year 3, and so on and so forth. We also have the cap rate based on your initial purchase price, which is that $17,000 net operating income divided into your initial price plus your rehab plus your cost, so that $211. So it's an 8.3 cap rate on the purchase. So that's a pretty good investment for you. If you're selling it, I've given you a cap rate based on your after repaired value. So this is what it would look like if you were selling this property as a turnkey rental, you would market it to other investors at a 6.6 cap. So it's generating $17,000 a year divided into the new after repaired value or appraised value of $265. So it's a way that you can also use this to resell to your other investors after you've completed it.
This is Mark Cunningham again. Joe, I have a question for you.
Yeah.
I love how you break out the cap rates there
Mm-hmm.
on the purchase price as well as repair value. One of the common questions that I'm always asked from investors who are considering selling a property that maybe we're managing is they say, when I'm trying to calculate my cap rate, should I calculate it based upon what I paid for it, or should I calculate it based upon what it is worth now? How would you answer that question?
What's your preference?
Yeah.
Right? And so it really comes back to you say to the investor, what is your preference? If you want to see a really high cap rate, calculate it on what you paid for it 5 years ago. But if you want to see what is that cap rate today, if you were going to resell it, calculate it based on today's value.
Now here's another way of looking at it, because it is a question that we all get all the time. So if I can sell this at a 6.6 cap, and I can buy another property or 2 at a 7.5 cap, I actually might consider selling this. I'm not saying I'm going to sell it, but that's the way I'm thinking. It's like, well, I've added so much value here, but my cap isn't that good. I can do better with other properties, continue adding value. This is the great discussion that we all have with our clients, and this is why the spreadsheet is so cool, because it allows us to actually answer with good questions that the client can say, well, here's what I'm thinking about doing. Where does this lead me? And we can go back and forth. But, you know, Joe, this is brilliant.
Thank you. Chris, did I explain that? Any questions from you on that?
Yeah, no, that was a really good explanation. And I got a few more for you. I just see a question coming in here. Someone asked, did it take me 4 months to do the $20K worth of repairs?
What took you so long?
I actually spent $30,000. We estimated $19,000, spent $30,000, so right on target there. It took us actually about 3 months to do everything, and that 4th month was just closing out to sell it. So 3 months to do about $30,000 worth of repairs, and that was with a couple of curveballs. With like I said, the plumbing was unexpected. Was the main thing. That was like $3,000 replacing all the plumbing, and then. my general contractor had a major health issue and dropped the project halfway through just because he was in the hospital. So that threw a nice curveball in there, and very luckily we were able to, it had added a few more dollars, took a few more weeks, but dodged a major bullet there. So, see, I'm looking at this hindsight now because I made about just under $26,000 profit flipping. Now I'm looking at this rental income of a 16% cash-on-cash return. Man, I wish I kind of kept this now. Just to play devil's advocate, though, Mark, it's normally 10%, right, for property management?
I think, yeah, 10%.
To you.
10% is a pretty standard number to throw into that spreadsheet there. I mean, ours is a little bit lower, what we charge, but yes, you're figuring out.
Tell me what you would charge if I don't know if it depends on actually when these real numbers.
I know you, but if it's one of your clients, we'd probably charge them about 8.5. I would also, as I run these numbers on my stuff for the maintenance and repairs, I budget 1 month of rent for my maintenance and repairs. So I would have personally budgeted a little bit higher on my monthly repairs.
So we're whispering over. He just did a full rehab on it, and that's why I might suggest maybe that's a little high. Obviously, no one knows. But Chris, I'm sort of almost defending you a little bit, but you are the property manager.
Well, I'm your property manager, so I'm going to spend more of your money, Chris,
there you go.
to repair things.
All right. Well, let's say that then, Mark. So if I totally want to do hands off, so I just get my rent check deposit every month from you, Mark. Let's see what those numbers would look like. I mean, that's still almost 8% cash-on-cash return at a 7% cap rate. I mean, those are good numbers in this market right now. Man.
Yeah. And you're being aggressive now with your expenses as you budget.
Yeah. And we might be able to bump up the rent a little bit more and put those other things down. But I'm being, I think, conservative with my numbers, which, hey, I always like to hope for the best, but let's plan realistically and plan for the worst. That way. So, Joe, one thing I want to talk about on this page here, too, the summary page, I found really, really intriguing. Give us the rundown on this, because I'm sure other people, too, I already see a few questions asking about the spreadsheet. So finish this out for us if you could.
Yeah, so we looked just at the third tab, which is the hard money purchase, but there's also a tab where you can compare if you paid with cash, if you financed it with 25% down, and then, of course, if you did hard money. And then the summary puts all three of those together, and it breaks down for you the cash flow statements, how much you would need to invest in each of the three scenarios, your total equity in each of the three scenarios, and then scroll down, it'll compare your returns that you get. Now what you're going to see, your cap rates are going to be the same, because your cap rates make no impact, or the financing makes no impact on the cap rate. I guess there's one that's off just due to rounding. But your cap rates are going to be the same. What's going to vary is going to be your cash-on-cash return. You're going to have better cash-on-cash if you leverage, and in this case, better cash-on-cash if you put 20% down and pay for the rehab out of your pocket.
My immediate reaction, though, is it's not that different. It is a little bit different, but I'm surprised that it's not more different. It leads me to think, maybe I don't want it.
Well, the reason it's not that much different is because there was not a ton of spread in this property. You had to put cash down to make scenario number 3 work. If you had a property that had a lot more equity in it, it would be a lot different.
Exactly. Yep.
So this is a way that you can compare on a real-time property which one of these 3 scenarios should I use to buy this home.
So let me ask you this now. I never thought about this, but let's say I saw this property. I was able to get it from who I got from for $185, which was a relatively good deal. And I came straight to you saying, hey, Joe, the property was habitable, it's livable. Everything's functioning, but it, needs some work before I could rent it out or sell it or whatever. If I came to you, would just standard thing, 25% down, and you'd have done that? Any other curveballs in there, or is that just kind of like a routine bread and butter investment loan?
That's just a bread and butter investment loan. In this scenario, 25% down. You could do more or less down, but for purposes of comparison, I selected 25% down.
Okay.
But go back. I'd like to just show, if you would go to the Inputs tab.
Yep.
Scroll up, please. Let's just say you bought this property at $165. Let's just say you got a deal on it.
Sure.
Now let's look at the summary page. Scroll down. Look how much better your cash-on-cash return is in scenario 3 because you didn't have to put as much cash in out of your pocket.
So this leads you to say if the spread is bigger, you want to do more with hard money.
Correct.
And that's where the hard money guys come in. And they'll be the first ones to say, we're expensive. You just need to calculate if it's worth it. And that is where it would be more worth it. And here it is, Joe shows you the numbers.
And if you'll scroll up on this page, Chris, look in the third column over, you're not putting as much money out of your pocket in that scenario. And you could do...
so 20 would be 20 grand down in this scenario.
Correct. And previously it was like, I think, 31 or 32, something like that.
And maybe you could do 3 of these instead of 1.
Right. If you had less money to invest, that might make more sense.
So let me ask our listeners this question, and actually, I mean, you guys can jump in here too with your opinion. So I just put back the real numbers of a 185 purchase price with also Mark managing the property for me. I would have had $32,000 cash in this property after I fixed it up, refinanced it with Joe at a close to 8% cash on cash return, 7 cap. Mm-hmm. So out there for the listeners, would you guys take a $26,000 profit or holding this long term? I'm just curious if people have opinions on here. Go ahead and ask your questions as well. And Joe, Mark, Charles, questions, insights, opinions. I know it's all different, but I want to learn from it, you guys.
I would hold it long term. That's my vote.
Yeah, I actually told you to hold this one long term, Chris. So I told you 2 months ago that, so you know what my vote was.
Yeah.
I'm a long term guy. Yeah, I don't like paying short term capital gains. It's like 90% or something. So I would have held it.
Yeah, and if you're going to flip it, hold it for that year time frame so that you get you're not paying a higher tax rate. It's important for people to remember if you're going to flip something, you're paying a higher tax rate to the government because of the flip. Well, that time frame caps at 12 months. So even in some quote-unquote flips, if you can make the flip happen in month 13 where you close, you're still thinking of it as a flip, but the government will not tax it as a flip. They'll tax it as a buy and hold, so you'll pay a significantly smaller amount of taxes.
Yep, that's a good point. Yeah, I mean, I'm more of a general, I never actually really wanted to get into flipping in the first place. Just a good opportunity popped up. I wanted to do one to see what it was like, but looking back and even halfway through the project, I was I should hold on to this, but stuck with my original plan. No complaints. I made money, great learning experience, but yeah, when I do them again, it'll be buy and hold because just so much better for long-term wealth creation. All right, so got a question here from a few people. Essentially, is this the same spreadsheet that we've seen in the weeks before, or are you just on a different tab on the top? So no, this is a completely new spreadsheet. Kind of funny, I'd actually used the old spreadsheet that you guys have seen us use numerous times, and I was kind of like fiddling with the numbers to make it work, and Joe emailed me back and saying, no, dude, use this spreadsheet instead. And I was like, where did this come from? So this is a brand new spreadsheet. And I did talk to Joe before the webinar. He's happy to share it with you guys. So I will post it in the show notes on the webinar once the recording's up. So just denverinvestmentrealestate.com/webinar4. If you can't get it on there, email one of us. We can email it to you as well. Joe, so I don't want to take too much more time for the next topic, but any final words of wisdom on the spreadsheet or just some FYIs for people as they use this?
You know what? I think it just comes down to putting in the right information. Put in the right information. Be conservative on your ARV. I see a lot of investors get very optimistic about their ARV, and then when it doesn't work, they're upset. So I think you should make sure you're realistic, maybe even conservative on that. I agree with Mark. Factor in an appropriate amount for property management and an appropriate amount for repairs and maintenance. Those will probably always be, with repairs and maintenance, probably always be more expensive than you think. So I think that 1 month is a great metric. And don't forget if you have HOA dues, landscaping, put in all of your expenses, because I've seen people miss HOA dues. And they're like, oh my God, this was going to be a 12 cap, and then they plug in their HOA dues. Oh, it's a 6 cap, and they're not nearly as excited about it. So make sure that you have the appropriate information that you're putting in on that first tab.
Great. Wonderful. All right, Charles or Mark, any final words of wisdom or thoughts before we move on?
There's a lot going on here, and I think whoever's listening should send Joe or any of us an email, take a look at it, and ask us questions, because I've never seen anything like this. I'm whispering to Joe, this is incredible. This is really, really, really nice, and we're going to want to get this out more. But come to us, any of the three of us, four of us, if you have questions on it.
And the irony is Charles's name is on the spreadsheet, so.
You helped develop this.
Many late nights I put into this. So.
All right. Let me get back to my slides here. So kind of the next topic, I think we'll probably take up the rest of the webinar. But guys, keep typing in questions here. We'll definitely make time to get to them. I want to move into our investing strategy series. This is a kind of a brand new thing that we just kicked off 2 or 3 weeks ago. And the way this came about was actually I was talking with a friend about, I guess probably about 6 weeks ago, just kind of doing some very basic personal finance and how to, save money in their 401k for their employer. Just very, very basic investing for that and personal finance. And I kept harping on, I was like, do you have your goals written down? Do you have your basic plans written down for how much you want to save, all this stuff? And the answer is no. And I'm a big believer in if you write things down, you look at your goals regularly, they're a lot more likely to happen. And then after I was kind of lecturing this person on here, I was thinking to myself, I was like, oh, some 4-letter word. I was like, you know what? I need to take my own advice here, because I've done this in previous businesses and previous things, but as I'm kind of turning my focus onto real estate now, I realized I did not have a solid plan written down for what I want to do investing-wise, and I was like, I need to take my own advice. So I said, I'm going to write my investing strategy, and rather than just writing it for myself to see, hey, I'd rather put it out there on the website, and hopefully I can get Charles and other people like Joe and Mark and other just, people around town to share their strategies. Because the whole idea here is I want people to play devil's advocate with me. Do it politely, but hey, shoot holes in my strategy. What am I missing? Where could I be better? Let's discuss it. And I want to learn from people like Charles and Joe and Mark and also other people out in the webinar. And so I started thinking about this. Hey, this could be a really powerful tool or series for other people out there to leverage. They could learn from it. If you guys ever want to, hey, join us. We're happy to help you out with your strategy, help you bounce questions around, write it down, do whatever. So I'm going to share my strategy right now and actually have everyone discuss it. And actually I do want to mention actually on September 18th, we're actually doing our first live in-person Create Your Investing Strategy workshop. So this is at the Your Castle headquarters in Denver. The address is available at yourcastle.org/training. Go there, check it out. It's going to be not a class, but a workshop. We'll have, come here, work with us. Charles will be there, Joe will be there, I'll be there. We'll sit there, answer questions. And there's no right or wrong way to do this. We're just there to kind of bounce ideas around and hopefully help you either write your strategy down or move your needle a little bit more forward, help you kind of get things figured out. So going back to, let's see, my strategy here. So if you guys want to follow along with this, go to denverinvestmentrealestate.com, education, investing strategies. And you'll see mine is up, Charles is up, Joe and Mark, we're going to have theirs up, next few weeks as well. I'm going to click on mine here. So the summary of mine is, for me, investing is it's a giant game. I want to build, I say, 3 streams of income. I'm kind of fascinated with residual income. Real estate's a great way, but it's not the only way to do it. I built a business in college. Actually, I built 2 businesses in college that still pay residual income.
Sorry to interrupt. Just so you know, we don't see it on our end.
You're not seeing it, huh?
I'm seeing the spreadsheet.
What about, can you see it now?
Nope.
Yeah, we can't see your mouse moving.
Yep, there we go.
There it goes.
All right. Okay, so everyone knows. So thanks, Charles. So education, investing strategies, just so everyone can see where to go. I'm clicking on Chris Lopez's investing strategy. So I like building a business. I believe in the stock market investing, and I want to do real estate investing. So my goal is to build my real estate business, coupled with some internet stuff I'm doing as well, just to produce as much cash as possible, take it, invest in the stock market, invest in real estate. Use the business money, because it's very hard to make business income last the long term, but stock market and real estate, I think, are great places for long-term wealth. So guys, I'm gonna start going down bullet points here. Interrupt me, jump in, and we can discuss them. One of the things I realize is I like to focus on what I actually can control. I can't control the real estate market, but I can control increasing my income and living frugal to minimize my expenses. I like to shoot for living off of 50% or less of my income. So two ways to look at that. Live a lot cheaper or make more money, or do a combination of both. Try, and I have that italicized, try not to worry about what I can't, like what the real estate market is doing. Maintain high cash reserves to ride out the rough times. From the people I've talked with and the things I've studied, it seems like as long as you can hold on to your property through the ups and downs, if you can hold on to it for 30 or 40 years, you're set for life. If you can't ride out a storm, or if the market tanks 20% in a couple of years, that's when you get screwed. So cash is king. Generate as much cash as possible and invest it into high quality assets. So Denver real estate and the S&P 500. I'm going to focus all my efforts in investing in Denver. I'm bullish on it long term, just from like the city as a whole, the growth, the aspects. I attended one of Charles's webinars or classes on going over the stats for Denver, and he goes into all the details there. And I'm going to try to take my emotion out of investing. I'm just going to follow the dollar cost averaging method. You know what? As I have enough money to buy property, it makes sense to my other finances, I'll buy a property. And then even if the market's high, I'll buy a property. Market's low, hey, I'll buy 1 or 2 properties. But again, I just want to acquire the property and hold on to it for 20 or 30 years, because I really think now, even today's market, hey, if I have to overpay a few more $1,000s I wanted to, you know, $220,000 for a condo rather than $200,000 in 30 years, I don't think I'm going to really care. I'll be like, man, remember those days when condos were below $300,000? Those were the days. Focus on properties that cash flow. If it doesn't cash flow, I'll put more money down. Pursue the best opportunities based on current market and personal conditions. So if I can make a higher return elsewhere, I might put my money there. But real estate is really hard to beat the returns you can find in real estate. Last couple of things, network with as many people as possible. And this is one of the reasons I actually got really into real estate last year. I tried to do a lot of day trading on the stock market and foreign currency, and that's just you versus the system, you behind your computer screen. Doesn't matter who you know or what you do, it's you versus the big guys. I'm not going to beat JP Morgan Chase, I'm not going to beat those guys. But as you guys know in real estate, if you know people, you can find deals, you can get things happening. And then I'm a big believer in the more you do something, it builds momentum, and just like interest will compound to make you richer, the more people I know, the more I do, even if I'm just buying basic deals in the beginning and doing, hey, you know, I'll say very average deals, it'll have a compounding effect. And I'll be able to buy better deals in the future, learn more from that, and do more advanced things. And lastly, people laugh at this sometimes, but I always remind myself, just don't be stupid. That's kind of my final bullet point. So don't chase high-risk investments, don't get caught up in the moment, and just don't be stupid. So Charles, Mark, Joe, any things that jump out at you?
You know, I love this. I think it's great. And maybe it's time, Chris, that we mentioned that we are going to be doing a series of workshops. And I think it's going to be really based on yours, because I think you did such a great job, where we're going to get investors together and just have them put a basic business plan on what they're trying to achieve. And Joe and I and you are going to be there, and Mark, we'd love to have you there as well. And of course, some people are listening live, some are recorded. So maybe the best way to find out when our next one is just to send me or Chris an email, and we'll let you know. But what we're looking to do is have you guys kind of work with you and say, what are you looking to do? Put it down on paper. Let's do some vetting. Let's talk to a property manager. Does that make sense? Let's talk to the loan guy. Maybe you're crazy. Maybe you can't do it, or maybe you can. So please let us know if you want to know when the next one is.
Joe, Mark, any thoughts or critiques? And please, play devil's advocate. I've got thick skin. You're not gonna hurt my feelings.
I think it's great that you're writing these things down. I heard somewhere just the other day reading a book and was talking about the value of writing down your goals to getting that out there from the long term. And the stat they gave through a study was that for men, you are like 75% more likely to achieve your goal by writing it down. And for women, you're about 75% more likely to achieve your goal by telling somebody. So take that for what it's worth, but interesting. I love this. I think this is wonderful. I wish I would have done this, exactly what you're doing right here, many years ago, because it keeps you focused. It helps you stay on target and stay on track. So I absolutely love it.
I agree. I think it's terrific, and I agree with what Mark said. Writing down your goals and sharing them with someone, that's something that I do every year at the beginning of the year, and then every week with my weekly goals. I share it with my accountability partner. And I think doing this, and I really applaud you, Chris, for exposing this to all of the audience on what's your goals, because if you trip up, you're going to have hundreds of people on the webinar that are going to say, hey, what happened? And then you're going to have to own it, right? But I think that's a way to hold yourself accountable, sharing it out in public. I love it.
And Joe, who's your accountability partner?
Charles Roberts.
So you see, the apple doesn't fall far from the tree. We all work together. We all help each other by doing exactly what we're talking about here. And that's what we're trying to get that message spread out.
And I think one of the values that you'll find, Chris, with this is 12 months from now, when you're looking at an opportunity and your emotions are involved and you don't know what to do and you're going back and forth and you're confused, you can go back to this and view this, and it'll realign you. It'll get you back on track. You'll say, oh, that's right. When I was clear and focused, I wrote this plan down. So it's a great reference point for you to stay on track for your future self.
Exactly. That was one of my points for doing this, was so I wouldn't get caught up in the moment. And, hey, in the past, I've definitely matured for a bit, and I've made some very stupid personal and business and investing mistakes in the past because, my emotions got riled up, and you know what? That was kind of just dumb. But that's a big part of my reason, is to help kind of keep my emotions in check, because I do get worked up sometimes. So it was funny. I was talking to Charles about this a few weeks ago, and I actually talked to Joe yesterday, the day before, and they're both like, you know what? My goals are so simple. I'm not even quite sure how to write a long blog article about it, and I thought that was very telling and powerful itself. Is current successful investors have very, very simple investing plans. Like, they sound like Joe. He could write it out in a few bullet points, like nothing fancy, nothing major. It's not some 21-page, convoluted business plan. He probably didn't go to some guru and paid him $5,000 to teach him how to do this goal-setting stuff. Like, you don't have to make it complicated. You have to make it advanced. Just figure things out that fit with your strategy and go with it. So Charles, we got a few more minutes left. And actually, if anyone has any questions out there, insights, man, put it away. We want to hear from you guys. If you guys have questions on your own strategies, please type it in there. But Charles, I took your strategy here and summed it up in a few bullet points. So why don't you kind of give people a quick rundown on yours?
Yeah, mine wasn't as detailed, and in a lot of ways yours is better. But I kind of, as I was sitting there on a Saturday afternoon with my dog sitting on me typing, I got across just a couple of points. One is that I'm a big long-term wealth guy. I've done lots of fix and flips. I've gone through a horrendous downturn. I'll probably go through 2 more in my career, and I understand that. For my risk-reward balance, I'm a long-term guy because I think long-term guy is a better way to build large wealth, taking less risk for the future. So that's my strategy. Now, if you're a fix and flipper, that's awesome. Go for it. Be great at it. Everybody can have a different strategy. And then if you look at the third bullet, I spend a lot of time talking about something that's really important to me, which is not thinking that you're the greatest investor, because you're not. I'm not either. And that you're going to find the best property ever, because you won't, and neither will I. The problem is that there is an enormous industry that travels the country, probably travels the world, charging people thousands of dollars, teaching them how to buy the perfect property. And what I find is so many people spend $10,000, $20,000, $40,000 and never actually buy anything, and frankly die poor. And it really pisses me off. So what I talk about is that it's not about buying the perfect property. If you can, great, but most likely it'll be a little less than perfect. It's about understanding what you bring to the table and buying the right property for you. So, for example, in my latest round of purchases, I bought 6 properties. Were they the perfect properties? I don't know. I bought 3 in Green Valley Ranch, townhomes and 3 in Aurora South condos, but they were great for me because I know what I'm good at, I know what I'm not good at. The numbers made sense to me, and I'm going to build huge wealth from these 6 additional properties. So that's what I'm trying to get across to people, is that they're sold literally and figuratively these lessons on how to buy the perfect property. And it's just very difficult to do that because there are hundreds and hundreds of other professional investors trying to find the same property. So I just counsel people, take a little bit of the pressure off yourself, but look at you and find out what would be the right property for you to own for the next 20 years. And I personally think that's a much better, more realistic strategy for building wealth in real estate.
Well said.
Thank you. Gentlemen?
And just to clarify too, Charles, I know we've talked about this all thing, but do you only invest in real estate and nothing else?
Right. So as you know, rhetorical question, I have about, at this moment, I have about 52, 53% of my wealth, my money, in real estate. I have about 40-something% in stocks and bonds, and I got, a big lump in my, mattress with a whole bunch of cash because I like to protect myself from downturns. So, call it 50% real estate, 40% stocks and bonds, and maybe 8 or 9, something like that, percent cash. And to me, that just makes sense. Real estate will go down sometime, stocks and bonds will go down. I just want to be here for the long term. I spread it out. And I really tell people, as much as I love real estate, just be careful about putting all your money in real estate. Like, you haven't maybe been through a downturn of 03 to 07 like I have. And it sounds, Mark, were you kind of, you were an investor then, so you know viscerally what that was like. You're going to have to go through some of these things. So I'm an advocate of not being stupid and spread the money around a little bit.
Keep it simple and don't be stupid, huh?
Yeah.
So as Charles mentioned a few minutes ago, we are starting some investing strategy workshops. So join us. The first one is September 18th, which I know as we record this might be outdated. But in the future, reach out to us. We'll kind of figure out a more centralized place to put these workshop classes. This will be our first one, and we'll get more organized on a calendar for you guys to go visit and see them.
And in case you're wondering, no, we're not charging for this. That's not how we make our money. It's not how we want to make our money. We want to build our circles, build our spheres, help people out, work with you if it makes sense. So please come to this or a future one, and come with lots of questions.
All right, so we got a few minutes left, and I was actually talking with somebody I connected with a couple months ago through the website. And good question here I wanted to run by you guys because he's trying to figure things out. I know a lot of this is hard, but he's not the only person with this question. So he currently lives in San Diego. He's in the military, and he's renting at the moment. But he's leaving the military at the end of 2018, and when he leaves, he'll get paid a decent amount of money, about $2,400 a month just for housing, on top of what he already makes. So he's considering the possibility of purchasing a home in San Diego this December in 2017, living in it for a year, and then continuing to save as much as possible. And then when he moves out to Colorado, I think he wants to move out to the Boulder area is what he said. So once he moves out to Boulder or Denver area, he wants to rent out the San Diego property and then buy a new property for personal residence in Colorado. So he asked me, does this idea of owning 2 properties in the next 12 to 15 months in 2 different states, does that sound crazy to you? And he says, I haven't bought my first home yet, but I'm trying to figure out how to buy 2 in a relatively short amount of time. It'll be easier to secure a VA loan while he still has plenty of time left in the military, but the loan on the home in Colorado will have to come from a different vehicle, possibly an FHA loan. He has a nest egg of about $20,000 that he'll increase about $30,000 next year that he can use for a down payment. So, Joe, Mark, Charles, any advice or insight for this guy?
The big thing I would say is, VA and FHA are for your primary residence. So if we do a VA loan while he's living in California, that's fine. But he would then, if he wanted to move to Colorado, he would have to live here and show that this is now where he's living a year later or 18 months later or whatever it might be in order to qualify for a new primary residence loan here. You do have to live in the property to use any sort of those government-secured financing.
But there's no seasoning period because obviously he's in the military. He'll have, ironclad documents saying he was transferred to here. So he could have an existing VA loan.
Well, it says he's getting out of the military.
Is he getting out?
The
Oh,
military is not transferring him.
I'm sorry, I didn't catch that. Okay, so sorry. So what you're saying is that he could do the VA there, but when he moves here, he won't.
Well, he would need to live here
Yeah.
to buy a primary residence.
Okay.
Yeah.
So you think that? How do you feel about this in terms of if you were his lender, and you were doing his loan here? What do you think about that?
I mean, I would want to see his paycheck stubs. I'd want to see that he moved here. I'd want to see why he moved here. You know, we need to verify that this is now his primary residence.
Okay.
Yeah.
But if it's legit, I mean, this guy's not lying. That's okay. From a lending viewpoint, that sounds good.
Mm-hmm.
How about a property management viewpoint of having a home in San Diego?
Well, from an investment standpoint, you're not going to cash flow a home in San Diego unless you put down an awful lot of money on that property.
That's right.
So from the investor side of things, do I want to live in Denver and have a rental property in San Diego? I don't know. You need to think through that. And you're going to have to throw down a lot of money to make that thing cash flow. That's just the nature of the market in San Diego.
Now, maybe he's going to move back. Maybe that's where he's from. Maybe this is actually something he hasn't told us, but in 5 or 10 years he wants to live there and have someone else help pay it off. Maybe it's not just an investment. So there could be a bunch of other things going on here. But it sounds like he could do this if he wanted to. Is it the best use of his money? You know, there might be better, but there might be other reasons why this would make sense for him.
So it sounds like he needs to talk to either Joe or maybe a loan officer in California or both and kind of get down to details and figure out how the numbers work and how things work for his situation. Right, Joe?
Yep, and actually I spoke with this person yesterday, so it's very timely.
Wonderful. So actually, I do have a question because I don't know too much about VA loans, and I was talking to a friend who bought a house, moved out, and actually kept it as a rental. Are you allowed to keep a property that you lived in for a year or how long? So you buy a property for your personal residence with the VA loan. Are you able to then move out and keep it as a rental like you can with an FHA loan? If so, what are the rules with that, Joe?
Yeah, as long as you've met your obligation that was your primary residence and you have occupied it as your primary residence, if you move out at a later date according to the terms of your note, that's completely fine for you to rent that property out.
So are VA loans, are they standardized to like 12 months, 24 months? Do they change? Like, how would you even figure that out?
12 months minimum.
Okay. But it can vary depending on the loan?
Generally not, but you know, this is a touchy subject because I don't work for all lenders. I just work for Castle and Cook. So I can't tell you if other lenders have their own rules or guidelines, but you know, you really need to, you know, house hacking I know is a popular thing, but you need to make sure that you're not treading in a gray area. If you're indicating to the Veterans Administration that you're planning to live in the property, you need to do so. And if something changes in your life and you need to move out of that property and you want to rent it out, that's fine, but you need to have met the terms of the note that it was going to be your primary residence and you did live there for that minimum of 12 months.
Great. And I'm glad you mentioned house hacking. We'll kind of start wrapping up on that note. The reason actually Mark was working with Charles today is he was recording a property management course for the website and also recording a audio segment on house hacking and, you know, what finding tenants and the property management aspect of that. So Charles and Joe recorded one on the finance side last week. We got a few more in the pipeline. So in the next few weeks, you know, late September, we will be releasing a little e-guide and audio series on house hacking with the expertise of Charles as a realtor, expertise as Joe as a lender, Mark's a property manager, and a couple case studies of guys who've done it successfully over the years. So be on the lookout for that because I know that's what a lot of people are looking for, and it's a great way to get yourself in the market. You know, I'm 35 now. I wish I knew about that concept and did it when I was 21 years old, you know, back then. But, oh, well, you live and learn. All right, so to wrap things up, I'm sure you guys probably hear this. Oh, the market's too expensive. Deals aren't out there. Charles, anyone ever say that to you recently?
Yeah, I get that a lot. And I come back with something.
What do you come back with? Because there's, you know, you've had a good month. There's 5 properties that we've helped investors with either sell or buy.
Yeah, I mean, just really quickly, what I went back to, I looked at the numbers, cap rates. I love cap rate back in the depths of the downturn, 07, 8, 9, 10, when we were buying up in Aurora North, and I'm looking at what we've been buying recently, and amazingly, our cap rates are really close. Typically, we're doing about 7.5 caps on relatively new attached properties, Aurora South type of areas. Back in the day, when we were buying for, you know, 90,000, we were renting for 950, but we had to put 10,000 into it. We were buying older properties. We might have been getting 8, 8.5 caps, slightly better, but you just have to look at the numbers to realize, no, actually, I'm happy with the numbers now. I just bought another 6, and that's why hopefully you're listening to this, to understand a little better what your options are and see if it makes sense for you.
So if you guys can see the slide, deals are out there. You can see in the month of August, we've helped 2 clients close 2 properties, a 7.2 cap and a 9.4 cap, which is kind of rare, but an awesome deal. And just got one under contract at a 7.4 cap on Monday. So that's it, guys. Let me wrap up the webinar here. Charles, Joe, Mark, thank you guys so much for coming out. I really appreciate it.
Yeah, hey, Chris, one thing I'd like to add to this, activity for August, I closed a transaction this morning that was a hard money purchase, refinance into a conventional loan, 0 cash invested by the investor. So they put 0 cash out of their pocket. They financed 100% of the purchase, renovations, and costs with their hard money lender. There was enough equity that we paid that loan off in full, and they put 0 cash out of their pocket over the past 4 months or 5 months while they were doing their renovation. So I'll start sending you those as well, so you can add those to your roundups every month.
Oh, if you could, that'd be great. And if you're able to kind of share those numbers, I know, hey, that'd be awesome to add on here and start sharing those stories as well. So thanks, Joe.
Yeah, thank you.
All right, guys. I know we're wrapping up. Any final thoughts or words of wisdom?
Oh, catch you on the next one. Thanks, Chris.
Hey, thanks, everyone. Thank you, guys, and everyone who came out. Thank you so much for spending your morning with us. We will see you next month.